eminent gentlemen need no introduction. Join us with that budget take. Nilesh Shah, MD at Kotak AMC, and Dharmesh Mehta, MD and CEO of Axis Capital. Nilesh, your first take on what did you make of a budget from a market's perspective and an overall perspective?
So from a market point of view, this budget is pro-agriculture, pro-rural, pro-infra. And while there are some aggressive assumptions on tax collection, at least the fiscal glide path is there. And equity markets have taken this budget far more supportive despite long-term capital gain tax being introduced, probably because it's being introduced fairly with grandfathering. However, the debt market has shown little bit of concern in terms of fiscal glide path, and there the 10-year yields have risen.
Yeah, and well, Dharmesh, that probably came to the fore in the way the bond yields reacted vis-a-vis how the equity markets reacted as well. One would have thought that with fiscal deficit numbers not being met, or at least not being at the level which the market had preempted, and LTCG making a comeback with STT remaining, that was probably the worst possible combo. The markets didn't take it too poorly.
Yeah, but see, this is the initial reaction. As people read the fine print, they need to see the entire budget. So whatever happens on the day of the budget is irrelevant. What happens after the 1 week of the budget is more important. And market was expecting something on the LTCG front, because that was most talked about topic in the entire media. So it's not come as a shocker. It was something known what it is. The fiscal deficit coming at 3.5 was also a little bit expected, but thanks to the oil prices going up the way they went last year. So people understood that part. The bigger concern for the market is whether they can achieve this 3.3 today, what they've announced for the next 1 year, especially oil being volatile. I believe that should be a bigger question mark, and that's what people are trying to find out. How will they achieve this whole target?
Yeah, a bunch of queries that came in, frankly, on that MF show hashtag as well about what will this do to my mutual fund investing, because now there is taxation opposed to not earlier and all of that. So let's just first take this picture out of the equation out of the picture. LTCG coming back the way it has, does it dampen the investing climate, Nilesh?
In the mutual fund or in the capital market, answer is no. It just lowers your return by about 10%. And that also the future return, not the current return. There is a very, very fair delivery on grandfathering of capital gains, which means whatever is your gain today, you don't have to pay tax on that. In future, whatever gain you accrue, you'll have to pay tax on it. And I think 10% is a reasonable tax. There are two unintended consequences of this. One, we have a cottage industry of bonus stripping. People buy bonus shares, sell bonus shares, book short-term capital loss artificially, adjust against short-term capital gain. So by not plugging bonus stripping, you are keeping that options open for investors. Second, by reducing the gap between long-term and short-term capital gain tax, unintentionally you will encourage people to trade because the gap is just 5%. Third, if you look at an alternate form of dividend distribution, it was through corporate buybacks. That was amounting to 50,000-60,000 crore last year. Now that's escaping the tax net. So you have introduced LTCG very fairly, no doubt about it, but without plugging the loopholes on buybacks, without plugging the loopholes on bonus strippings, and by reducing the gap between short and long-term capital gains tax, you may end up having some unintended consequences. The better way to present LTCG will be, let's have some layering. So up to 1 year 15%, up to 2 year 12.5%, up to 3 year 10%, up to 4 year 7.5%, beyond 5 years exempt. At least make people long-term investors.
Yeah, well, that's a suggestion. Hopefully the FM is listening here. Dharmesh, there's one small point though on this, because when we spoke to FIs, I know Samir Arora has been a poster boy, quite frankly, when it comes to that debate, but a bunch of other FIs that we spoke to today as well, the views were divergent. Taimur Beg, for example, was saying that as per them, it's present across multiple countries, and from an FI perspective, this will not really hurt. But there have been an equal number of people on the other side who say no large Asian nation really has this kind of a taxation, and India will probably stand out for the wrong reasons. What do you think your clients' reactions could be, if you've already spoken to them, that is?
And also keep in perspective, a lot of FIs have tax benefit because they come through Mauritius or some other countries. So obviously they will not be affected more. But I'm saying the equity cult was just coming into the country. Mutual funds has just started getting huge inflows in the last 1 year. So why do you want to rock the boat which is like going in such good speed? And that was driving the economy, that was driving the money raising activity. Why do you want to even hurt that boat? Secondly, when you're talking about LTCG, you're already charging STT. So you basically now you're doing a double taxation. If they remove STT, it was absolutely a normal thing. The people don't mind paying it.
Yeah, I think I heard him say in the Doordarshan interview that rolling back STT is on the table.
But that's supposed to be the most fair thing to do. Then people don't even debate. In fact, markets will actually be very euphoric if that happens, because you can't double tax, and that's especially when the equity culture is coming in. The most important point is this is going to be the largest money raising year for equities in India. We are talking about almost 20 to 30 billion dollars, which is what I know is supposed to be raised in the next 1 year. And that number, you need a really buoyant equity market and mutual fund investment. You're done, now you tax even the mutual fund distribution on the dividend distribution. So, and that was a double taxation again, because the companies already pay the tax, and then again via coming mutual fund, you also again going to pay a tax. So why complicate so much? And people were just coming to mutual funds, and you just again put a doubt in their mind. Obviously, people don't invest for a 10% kind of a botheration that you have to pay 10% tax. People invest if they think they're going to make money. That's a net game. But you just didn't want this kind of speed breakers to affect the sentiments today. But as you say, if they remove the STT, there will be no further debate on this topic.
Yeah, one certainly hopes that that's taken into consideration. You were not too disappointed with the fisc number, I would presume. It's pretty much in line with what the street was half anticipating.
So the number per se, 3.3%, it's still maintaining the glide path which Finance Minister had adequately hinted. One can also appreciate the change in oil prices, which dictates this kind of thing. What market, especially the debt market, is concerned is the aggressive projection of revenue, the GST collection. Now, equity market is thinking that with e-way bill introduction, GST collection will shoot up. The equity market is also taking solace from the fact that if average salaried employee is paying 75,000 rupees of tax, the people who are employing them, the average businessmen who give salary to these people, they are only paying average 25,000 tax. So there is huge leakage which was anecdotally available. Now it's proven statistically. That leakage will get plugged with the GST. Hence, the revenue collections will come. The debt market probably once bitten, twice shy. Today is assuming that even though the net borrowing program has remained more or less at the same level, because of the aggressive revenue projection, probably fiscal slippage could be there in FY19 as well as it was in FY18. So the reaction of both debt and equity markets are different. Equity is looking with optimism, with hope. The debt market is looking with little bit of suspect.
Yeah.
See, also in equity, you have to understand, the last 2 years have been really shocking years for the corporates, because one was demonetization, the second year was GST. Now this is going to be one full year that those shocks are behind you, and the real benefits of GST will start flowing in. So clearly people are also looking at earning upside coming in. So equity market is also pricing in some upside because of that. That now is the first full-blown year when people will see the real impact on the economy, obviously subject to where the oil prices go. And I'm not an oil expert, but people think the winter is over and you're going to summer, oil prices may soften a bit, which will definitely benefit the equity market. So we are playing a lot of hope in this case.
True. What about the divestment targets, Dharmesh? I mean, we spoke to the divestment secretary. He did mention that FY18 itself, the target is now being pushed to 1 lakh crore. So some work to be done there. But 80,000 crore conservative, and do you think they'll overshoot as they did in the current year as well?
Oil prices remain down. I think so they can achieve it and overshoot the target because there is a lot of demand. Definitely, if there's supply, people will go and buy. We're doing one of Hindustan Aeronautics, and we're seeing the kind of response we are getting already. So I believe there is real demand. If the valuations are correct, there will be ample bias for government divestments. But as I said, all depends on the sentiment at that given time. And don't forget, India is in the midst of a global rally.
Yeah.
It's not a standalone rally. In fact, we are in line with the global markets today, especially emerging markets.
True.
So in that sense, if something punches that global market rally, then you will have to find it. But I would say 80,000 crores achievable.
Okay, Nilesh, there's this whole boogie on the minds of certain people that what if there is over-populism, an excessive agrarian focus. There was, to an extent, some two moves taken. MSP, to a lot of people, came as a surprise, but maybe it was warranted. The universal healthcare scheme, and we don't quite know what shape and form it will take. I doubt it will really be full reimbursement, even though the finance ministry tweeted about it. It'll probably be some bit of a premium out there. What did you make of these moves?
So one, while agriculture contributes 18% of GDP, it contributes 70% of population. Is there a need to ensure that Bharat moves to India, or agriculture sector benefits as much as urban India is benefiting from liberalization? I think there's no debate about it. and look at some of the steps which are being envisaged. I'm not saying that that will get executed tomorrow, but what is envisaged? One, providing a 50% margin on cost for agriculture product. I mean, that's no big deal. Second, we are trying to connect farmers and consumers and removing the intermediate margin. I think that's a very welcome step. And earlier we were trying to do that via agriculture produce market committees, mandis. Now it is being done via 22,000 huts. So obviously the decentralization will result into this happening much faster. Third thing, whenever agriculture prices went in favor of farmers, we raised the bogey of inflation to say, ban the exports, bring the prices down, stop the holding, and so on and so forth. Now we are saying that we want to push exports from $30 billion to $100 billion. You push exports 3 times more in agriculture side, farmer and rural India will benefit tremendously.
Sure.
If we look at Operation Green in potato, tomato and onion, it's on the lines of Operation Flood. Not many people will remember that at the time of independence, our milk production was far, far lower than America. Today, I think we produce 3 times more than them. Today, we are the world's largest milk producer. What Amul has done to entire rural India is unbelievable. It's a success story. Amul is India's largest FMCG company. So Operation Flood has been extremely, extremely, extremely successful to India. If we can do that with Operation Green on tomatoes, potatoes and onions, that's going to benefit rural India significantly. So my guess is that this is the first time where agriculture is being supported in a right manner.
In a right manner.
The focus is on agro-processing, value add, storage, distribution, fast time to market, quality. I think if we can pull this through over next couple of years, the Indian consumption, which is right now moving on urban India, will suddenly start moving on rural India, and that's 70% of population.
Yeah.
It can really be a game changer.
To support even what Nilesh has said correctly, point is if you're targeting 8%, 8.5% growth, it cannot happen with the rural India coming in.
Sure.
So actually the entire focus now has to be on rural India. And if that goes, then India goes through the roof. Because then you bring, as he said, 70% of the population into this economy.
Yeah.
I think so there can be no other country in the world which can do better than India. But as I said, you have to execute those plans. That's most important.
So what does all of this mean for the market? Final thoughts from both of you. Dharmesh, let's start off with you first. Back to business as usual. And what is business as usual now?
As I said, market will be in a cautious mood because market is not running right now on only India fundamentals. Market has got a lot of things to look at. The paper supply coming in, as I said, oil prices, which is key. What happens to the other world markets? Is there any major issue in the world? Suddenly the nuclear button thing again comes up between 2 countries. You start worrying about it. So market has to watch out for a lot of these factors because there is humongous amount of paper coming in and good quality paper which everybody wants. So in that sense, market definitely will be on a cautious approach. The low-hanging fruit which was there last year is over, and now people will have to be very cautious in their approach, and the rate of return expectation has to go down substantially. You can't expect the market is going to give you another 20, 30, 40% return, which it gave you in the last 2 years. That's not going to happen.
Here. That's I think the most important takeaway. But Nilesh, to you, a final question on this show again, and from a market's perspective, from an investor's perspective, what's the key takeaway?
So one, quality will pay. Last year we see many kachra stock also running up. Some of them have started correcting in recent days. That's a very welcome correction. So focus on quality. Second is Dharmesh mentioned, please moderate your return expectation. Last 2 years you were playing on a Indian cricket pitch.
Yeah,
you could score 4s and 6. Now we are on South African pitch. If you apply like Virat Kohli, you will still score a century. But if you don't, then probably you'll get out on 0. The best way might be to play like Dean Elgar, take some blows on your body, but continue to hold on to your wicket, don't lose it. Third, the divergence between small, mid and large cap last year was 30%. This year it's going to narrow down. Last year marked very, very low volatility in equity market, almost giving an impression to an outsider that debt is a risky investment and equity is a safe investment. I mean, please don't forget that debt is not so risky and equity is bound to be risky. So this year there will be volatility. So be ready for volatility, moderate your return expectation. Divergence between small, mid, large will narrow down. But if you stay on this pitch and apply yourself, you'll still score a century.
And we won the third test match. So don't forget that. So
Yeah,
there's
there is
hope. Exactly.
There is hope. Okay. Gentlemen, thank you so much for taking the time out and joining us today. And thanks for tuning in.